Yeah, exactly, but they still, it matters.
I'll try to introduce us. Okay, well, thank you everybody for coming. I actually wanted to start with this little.
My favorite word. My favorite word.
Thing, but that's okay. So the trade wars. So thank you everybody for coming. We may or may not have a trade war.
With China, you do.
We have one with China, and the poster actually reflects that. So thank you, Trinity, for doing the poster with that. Thank you everybody for coming. Last minute, Geoff, for giving the idea of having this panel. I think Carrie's outside, but thank Carrie for managing to do this in a very sort of short, period. We are going to have basically three sort of perspectives from the different sort of fields of economics, if you want. At least that's how I thought about this. So Chris Magee will be first, and he will talk on the sort of broader trade aspects of the tariffs. Then Geoff Schneider will talk about development sort of aspects of, tariffs that are imposed or might be imposed, because we don't know exactly what will happen. And at the end, I'll talk a little bit about the macroeconomic effects of the tariffs. So, Chris, about 10 to 12 minutes each, and then we would switch to questions. So, talk with that. There we go. And we want this one. Yeah.
Want to hide those people?
And what?
You can hide people if you want.
Yeah, I don't necessarily.
All right. So the economist, so the economist calls this the worst policy shock in trade history. And so I'll show you a graph why that is. So this is from the budget lab at Yale. They did an estimate of what the effects would be of the tariff announcement from last Wednesday, Liberation Day. And so you can see that gradually over time, since 1900, we've had falling tariffs. They're down to about 2%, when Trump comes into office. We get a little bit of an increase in his first term in office, and Biden largely keeps those tariffs in place. But the tariffs have essentially risen to about 3% on average in the U.S. And then last Wednesday, his announcement would have jumped them up to the Yale Budget Lab, I think, estimated 22.5% would be the average effective tariff, right? So we got this enormous tariff that gets us back to levels of about pre-World War I levels of tariffs, right? So again, the Yale Budget Lab estimates what the effects would be. This would kind of raise the price level by about 2.3%. That's about $3,800 per household on average. Anyway, I'm not. And the unemployment rate probably rise about a half percent, which is about 600,000. That's what their estimate is. So why would it be so problematic? Why would it be so problematic? These high tariffs. The stock market, you can see the stock market reaction. The announcement happens right at the end of the day, April 2nd, April 3rd, and April 4th, last Thursday and Friday. You see the markets drop. I think we lost about $10 trillion, all in all, in the drops. And then the markets would surge every time there would be a rumor that Trump was going to rescind the tariffs. And then the rumor would be rebutted and the stock market would fluctuate again. And then here's kind of yesterday when Trump announced that he would rescind the reciprocal part of the tariffs, but leave the 10% higher tariffs on all countries across the world. So that's still a massive trade policy shock, I would say, right? They're still raising tariffs, probably, I'm not sure what Yale Budget Lab will estimate, but my guess is high teens will be the percentage tariff, we'll have compared to a 2% prior to these things. So we haven't kind of eliminated the trade war. We haven't gotten rid of the tariffs. All that's happened is that we've gotten rid of the vastly different tariffs on each country that Trump had imposed. We put those tariffs, the tariffs differed by country because they were set based on the foreign country's trade surplus with the US. If the other country had a big trade surplus with the US, then they got hit with massive tariff. If they didn't have a trade surplus with the US, then they would just pay the 10% tariff. It's across the board. Okay. So why is Trump doing this? Well, I think this is the key thing for him, right? This shows the current account, which is basically the surplus or deficit in goods and services trade. There's also some income flow with it. But this mainly shows you what's happening to the trade deficit. Every time the line goes down, then we have a bigger trade deficit. And you can see what effect the tariffs have on it. If you look, Trump put high tariffs on China and some other things around here. Those tariffs largely stayed around under Biden, and the trade deficit got worse. So there's, we don't see any kind of improvement in the trade deficit as a result of the previous kind of round of tariff increases that happened. All right. So I think the reason Trump is putting tariffs on is that he's a mercantilist, right? I would say his philosophy aligns with the dominant philosophy in the 1700s that a country's economic wealth is determined by basically how much gold and silver are within the borders of the country. And so how do you get more gold and silver for your country? Well, you can colonize the rest of the world and take their resources. You see that with Trump, right? Where he wants Greenland, he wants Iraq to give us their oil. So he wants Ukraine to give us all their minerals, if we're going to help them. So that's kind of colonial aspect of this mercantilist thinking. But the other aspect of mercantilism is you've got to run trade surpluses so you can get money to flow into the country. Gold and silver will flow in if you're exporting more than you're importing. If you're running a trade deficit, gold and silver is flowing out, and that's a reduction in wealth, according to this thinking. And you see that with Trump in some of his statements that are like, he'll say things like, we're losing $800 billion a year. He's talking about trade. So he doesn't think of us as getting imports and by getting goods, but rather we're just losing this money. It's like we're flushing it down the toilet because we've got a trade deficit. So I think his hope is to get rid of this current account deficit that we're running by putting on tariffs, reorienting things. You'll see more sophisticated kind of policy thinkers will give you the same goal. They want to get rid of the trade deficit and bring back manufacturing jobs. All right, I would say from an economist standpoint, there are two different accounting identities that tell you why you get a trade deficit, right? The trade deficit is going to be a gap between savings and investment in the country. So if as a country we're saving less than we're investing, then we've got to get that extra investment somehow. It's got to come in from abroad. So money would have to flow in to finance the extra investment that we've got above and beyond the savings that we have as a country. The U.S. for a long time has been a low savings rate country, but we've had lots of investment. So the trade deficit is the cause of that. The other kind of accounting identity is that the current account right here plus the financial account or financial and capital accounts have to equal zero. So we need this balance of payments where if foreigners are trying to buy more U.S. assets than U.S. citizens are buying the foreign assets, then we're going to have a surplus in our financial account, and that's got to be matched by a deficit in our. And so really since the 1980s, there's been this massive foreign demand for U.S. assets. We're a safe haven, have been until recently anyway. And so when there's turmoil in the world, people buy U.S. government bonds, buy dollars. Foreign countries want to hold dollars as the reserve currency. So there's massive demand in the world for US assets, more demand than US citizens have for foreign assets. So the upshot is we've got a trade deficit. Okay. I think tariffs won't change the trade deficit unless they change that basic principle that the foreigners are kind of wanting US assets. There's a theorem in economics called the Lerner symmetry theorem. It says if you tax imports, that's the same as taxing exports. You're gonna reduce both imports and exports. You're not necessarily gonna change your trade deficit unless something fundamental happens in terms of these financial things. So I would say I don't think we should worry so much about the trade deficit. A lot of it is caused by foreigners being willing to take US dollars. Like if you look at our trade deficit, on average since 2000, we've had a trade deficit of about $600 billion a year. About $300 billion a year of that is actually paid for by foreigners taking US currency, taking dollars. And so about half of our trade deficit is actually paid for by just us printing up more dollars and giving those to them, right? So I think the fear is that when you're running a trade deficit, you're basically running up IOUs with the foreign countries, and they're acquiring US assets. You have to pay back eventually. I'm not so concerned about that. Right? So why has the reaction been so negative to this in terms of the stock market and the predictions about what's going to happen with the economy? Matías is going to talk more about kind of the macro effects. But I'll just say, I think the biggest problem here is uncertainty, right? There's massive uncertainty about what government policies are going to be in the US right now. We don't know what the tariff's going to be. The tariff today is different from what it was yesterday morning, radically different from what it was 2 weeks ago, and even very different from what it was a year ago. So, but if you're making an investment and trying to decide to build a big factory in the US, you're going to have to know what the policy is going to be 3 to 5 years from now. And you have probably at this point, you have no idea what that is. I would say the other massive problem, the one reason maybe why the stock market went up so much when Trump rescinded the reciprocal tariffs is there's a huge problem if we try to put a different tariff on every single country. Like it's much better to have a single tariff, even if it's at a high level that all countries pay, than to have radically different tariffs on everything. There's some trade agreements like NAFTA where to get the free trade, you've got to prove that the certain fraction of the good was produced in Mexico, say if it's coming from Mexico to, right? It's costly to do that. You've got to document where the good is coming from. So a lot of firms will actually not even bother. They'll pay the tariff instead of proving that the good should be tariff free because it's so costly to document where the good comes from. What Trump was going to do would we extend having to prove where the good was coming from to every trade with every country all around the world. So there'd be this massive administrative cost that would be added on to trade that we don't need to pay now, where we've got kind of a common tariff on all countries. So those are some of my initial thoughts. I'll let Geoff take over from here.
Thank you, Chris. Okay, so first thing is we'll start with what tariffs do. Tariffs are a percentage charge on a foreign good, right? And the higher the price is, the higher the amount of the tariff, right? So that's just basic supply and demand. That's what tariffs do. They raise prices. Now, that's going to be split between consumers in the form of higher prices or inflation, right? Or producers are going to lose money. One of those two things has to happen in general, depending on the market, right? So for example, what's happening right now, we have 125% tariffs on Chinese goods. So Walmart has called up their Chinese suppliers because most of the stuff you buy at Walmart comes from China. And they basically said, hey, you need to cut your prices for us because otherwise we're not going to sell any products. So what Walmart is doing is they're raising prices, but they're also demanding cuts in profits from the Chinese companies. The Chinese companies have basically said, the Chinese companies basically already lowered their prices about 10% for the initial 10% tariffs on China. They can't cut prices anymore because they would then go out of business. So basically, the additional tariffs now are just going to raise consumer prices. So you're going to see Walmart prices, Amazon prices just shoot up if these tariffs stay in place. So that's our future. Now, Trump's stated policy has been that he wants to reindustrialize the United States. So the ostensible purpose of the tariffs is reindustrialization. So that's something that I've studied my entire career, is policies to reindustrialize or to initially industrialize. I do a lot of work in Africa, and it's a big issue there. Like, how do you take an agrarian economy and industrialize it? Or in the US context, how do you take an economy that used to be an industrial powerhouse and reindustrialize it? So, and what we're going to see is that tariffs can be part of an industrialization process, but tariffs are not usually enough by themselves. And a lot of countries have done this, and some were very successful, and some were very unsuccessful, and some were slightly successful. So the record of doing this is not clear. In other words, even the best approaches to this aren't always successful. Okay, so here's why you want to protect your economy. The classic reason is an infant industry. You have an industry that's not competitive. You want to give it a chance to become competitive, so you protect it with tariffs, and you hope that it develops, and then it can become industrially competitive with the rest of the world, and then you can remove the tariffs after that. So this is usually a temporary strategy. It's a strategy that was used extraordinarily successfully by Japan, China, and South Korea, where they protected industries, subsidized industries, developed them into export powerhouses, right? So some countries have done this successfully. A lot of other countries have tried this with very mixed success. Many of you will remember the famous Nigerian car, right?
I'm glad to say I don't.
No? So that's an example. They protected and tried to develop their car industry. Turns out Nigeria does not have the technological capability, the worker skills, or any of the other necessities that would lead to car production. So there is no Nigerian car, despite the fact that they protected their car industry, so much so that their consumers spent billions of extra dollars in the cost of the cars they had to buy because of the protected tariffs, right? So tariffs are costing somebody a lot of money, and they may develop an industry or they may not, depending on other factors. You can also protect industries for strategic reasons, national defense, for example, but more importantly, from a development perspective, industrial clusters, right? This is why the CHIPS Act protected semiconductors. Semiconductors have a lot of synergy with other tech industries. So if you want your tech industry to be robust, you want Apple working with the computer chip company, right? You want that collaboration that fosters economic growth. So in general, industrial clusters, preserving the parts of the cluster end up being really useful and important. All right, you can protect against unfair trade. Of course, Trump says everybody's unfair to us. Look, some countries are. China is notoriously unfair. They are trying to rig the game for their industries. Most countries actually try and rig the game for their industries. The weirdest thing, in some ways, and Trump is actually right about this, is that we have not done that, right? While everybody else has been doing that. So almost everybody else subsidizes industries to give them an advantage, and we haven't done that as much. So, it is an interesting point, right? That there is a degree of unfair trade out there, although how much depends. It depends on which country, right? And this is broad brushstrokes. So you can also use them to raise revenue. And we know what percentage of the U.S. economy imports are. Are you going to talk about this? I don't want to steal your thunder.
No, that's.
Anybody know what percentage of the U.S. economy are imports? Yes, you can say, Chris, nobody else. 14%. So if you have a 10% tariff on 14% of your economy, how much money are you gonna make? I order math here. 1.4% of your GDP. That gonna pay off your budget deficit? Anyone know what our budget deficit, our national debt is as a percentage of GDP? Over 100%, right? Okay, so is this gonna solve our budget problems? It's not even gonna touch it, right? So, all right, so that's a different thing. Okay. This is why you don't want to protect industries. First of all, it benefits protected industries at the expense of others, like that Nigerian car industry. All of the other industries in Nigeria were losing out, but the money was going to the car industry, but it didn't go anywhere, right? So it benefits a protected industry at the expense of others. Consumers are hurt the most generally by tariffs, right? Because they pay higher prices. You can have the overprotection of domestic firms. One of the things we have seen over and over and over again is if you perpetually protect an industry and it never has to compete with other industries globally, it will never get efficient. It will never be competitive, which means you will have your tariffs forever unless you do something to wean an industry off tariffs. So the idea of generally having tariffs, not necessarily a good policy. And if you put tariffs on other countries, they will automatically do it. Anybody see what China has done already? Not just 84% tariffs, but they're also doing things to directly undermine US companies. And they're not going to sell us rare earth metals that we need for things like batteries, right? So like, this is war, and it's going to hurt for every industry it helps. It's going to hurt another industry. Okay, so if you want to study a country that did tariffs masterfully, I think probably the very top of the list would be South Korea. So why? First thing is, they didn't do general across the board tariffs. They did tariffs on the industries that they wanted to develop and thought that they could develop. So they picked industries that would create a lot of jobs, that had a lot of linkages to other industries, so they would develop their economy, create jobs, improve growth. So across the board tariffs are not going to help you develop specific industries. Why not? Because they raise the cost of inputs, right? So if you're a car industry and your steel costs 10% more, you're not going to be as competitive as a country that doesn't have to pay 10% more for their steel. So tariffs on inputs is stupid if you want to develop your industries. I mean, really just dumb, right? Nobody who wants to develop an industry does that. In fact, just the opposite. So what South Korea does, they want to develop their car industry. What do? They put a 100% tariff on foreign cars. So double the price of American cars. But they made steel and other inputs cheaper, right? So they had special concessions so that all inputs for their car industry were cheaper. So you don't do across the board tariffs, you do targeted tariffs, right? So duty-free imports. So subsidies, fostering domestic technology developments, right? So they had a whole bunch of other factors. The government built infrastructure for the companies. So the government gave them concessionary finance so that they could borrow loans, which when your industry is just starting out is really helpful. So tariffs plus a whole bunch of other government supports. But also, this is the most brilliant thing I think of all, was the reciprocity involved, which is they were going to protect industries only if the industry did something useful. You're not just going to get blanket protection forever. All industries that were protected were subject to monitorable performance standards where they would only keep getting the government support, including the tariffs, if they increased investment and employment, research and development funding, and succeeded in exports. Korea's focus was on exports. So in other words, protection without requirements is likely to create inefficient industries. But if you have some constraints on what the industry can do, you're much more likely to be successful. Okay, too much protectionism can be a disaster. I mean, history tells us that the countries that have had these really high tariffs don't generally grow very quickly. I'm thinking of India in 1991 when their tariff rate was 125%, and they had all these industries, but they weren't globally competitive, and they couldn't export any of those goods because they were inefficient, domestically produced ones that were not subject to any sort of market competition. UK after World War II, they took dyeing industries and the government bought them and then either subsidized them or protected them, again, not globally competitive. So you're not going to create globally competitive industries through tariff barriers alone. So why is Trump tariffs likely to have bad outcomes? First, they don't exclude intermediate goods, so the cost of manufacturing is going up. Tariffs on things that we can't produce ourselves are nonsensical. Why are we putting a tariff on coffee? We don't grow it. We're not going to develop a coffee industry. All a tariff on coffee does is make us pay more for coffee, right? I mean, it's not an industrial policy, but even worse, tariffs on rare earth minerals. China is the biggest source of rare earth minerals for us, and we're going to more than double their cost with a 125% tariff. Every industry that depends on those will not be as competitive as a result. We have developed a global supply chain over a very long time, over about 40 years. The idea that we can instantly switch to a domestic supply chain, you know, we don't have the capacity to produce all the things that Apple puts into an iPhone. They come from the parts come from dozens of different countries, Germany, China, India, upstate New York. So we got like one of the components, but nothing else. We can't produce it right now. We could in a decade maybe, but but not right away. So they're not complemented by essential other support. Uncertainty, as Matías will talk about, undermines investment. And then the trade wars themselves are going to hurt some of our most competitive industries. So I want to reiterate, I am not opposed to tariffs. I'm just opposed to stupid tariffs. So if you look at countries that do this effectively, like they protect industries, they subsidize it, they coordinate their universities and their innovation, which we cut, with industrial development, and that goes really well in a lot of cases. So if you leverage your technological advances and you create industrial clusters, oh man, that can be successful. That's not what we're doing, unfortunately, though. So I will stop there. Matías, all yours. Which the same thing. Yeah.
So, as I told myself, I'm going to talk a little bit about the macro part of this. Some of it has to do with tariffs, some of it also just simply with forecasts. So what you have here is yesterday's Atlanta Fed's GDP now. So this is the latest forecast by them. It is better than it was before. Does this have a little red dot here? Whatever. Okay, it was minus 2.8 and now it's minus 2.4, as you can see there. So they're predicting a massive, recession. It's not based just on tariffs. So I'm going to show you a little bit on what it is, but that's what they're suggesting. They're also showing you, which I think it's good, to the blue chip, consensus. So the consensus is something of a significant slowdown, something, around slightly more than 0.5% to somewhere, to 2-something%. So that's the more sort of moderate forecast of what would happen with the economy. I put there the famous phrase by John Kenneth Galbraith. Forecasts, should be taken with a grain of salt. So they're there so that they make astrologists look good, and so I wouldn't take too much into this. What is the basis of this kind of forecast? If you look at what's under the hood of the Atlanta Fed thing, and this has, it's been going on for quite a while. And so when it first appeared, it was very important, and a lot of people sort of looked at it. And most of it is actually caused by a significant, increase in imports and a significant, trade deficit that are sort of forecasted. Which is sort of a surprising thing, because if you imagine that the economy is going to slow down, normally what you have is that there will be less imports, and that tends to be a very strong sort of correlation. So I don't think that I'll take this too seriously. Mind you, why am I showing this one? Because I tend to look at objective data, not the objective. We're going to talk a little bit about uncertainty, but I'm not a big fan of uncertainty. I mean, uncertainty has increased. If you look at the VIX index, which is the traditional thing of looking at how markets are volatile, it's incredibly volatile. I tend to think that those are lagging, variables that don't say much about what will happen. You have to look at the objective data. And what the Atlanta Fed does actually is look at objective data. So what actually is going on, and actually imports did go up. And a good chunk of the imports that went up are actually possibly people advancing on the tariffs. So if you're going to have tariffs, you're going to buy things before the tariffs. And so that's one of the things. The other is a massive inflow and imports of gold that happened more recently. And so the thing I would say about that is that sure enough, those things may sort of have an impact, and perhaps we're going to have a little dip in the GDP in the first quarter. The numbers come April 30, I should say. But also, anything, so if you buy, goods that you are going to sort of use later on and you are not using them, they go as inventories, and inventories are investment and they have a positive effect on GDP, so they should cancel out. So I think that any significant effect that you're looking here will probably cancel out, and we shouldn't be expecting this sort of very rapid slowdown of the economy. So I think that the Atlanta Fed might be wrong. So again, I say this on the basis of what I told you. So forecasts are not necessarily very reliable, and I might be absolutely wrong on those things. So I'm just suggesting that. So the other two things, so beyond tariffs, and I'm going to say a couple of things. If you look at the objective data that we do have data on that. If you all probably heard of Doge getting in the payment systems of the United States, and that it's the only way the government actually does payments, and we have daily data on that. The Brookings Institution, because of the enormous amount of uncertainty that not just the tariffs, but Doge has created. We're going to cut spending on all sorts of things. They have put their little watch, and you can click and see where we are. And here's where we are. This is what we're actually spending compared to 2024. And we're actually a little bit above. And we have been above all through this period. So we're if we follow this trajectory, probably 6-7% above the spending of before. That doesn't mean that it has no consequences. We're cutting Medicaid, we're cutting certain programs, and we're spending more on contracts for what's the SpaceX or whatever it is that we're spending. So it has distributive consequences. It has real consequences in the economy, but so far there has been no diminishing in government spending. What's going on with consumption? So consumption did take a tumble when he sort of came in, but the last number from February actually went up. Not much, so there is a slowdown. I can suggest that a slowdown is likely. Again, these are actual data, not the expectations. So this is the actual data, what's going on. And so what's going on is that it seems to be consumption is slowing down, government spending is accelerating a little bit. Imports went up, which is a negative on GDP, but maybe compensated by inventories. And so overall, what we have is an economy that probably is, in terms of growth, status quo. It's not changing much. That doesn't say much about the tariffs. In the actual data, we don't have those, okay? My sort of prior as a macroeconomist is that tariffs, so what they will do is they will have an impact on certain inputs. It may take a long while to reorganize chains of production, but certain things, if we don't buy textiles from Bangladesh, and it's pretty fast for Honduras or Guatemala to be sending, selling textile goods. They it's not a complicated sort of relocating. So there are certain commodity, supply chain that would take a long while, and those would be a supply side shock if it was of the proportion that Chris showed at the beginning, of something that goes to the level of before the First World War. That's a supply shock even bigger than the pandemic in many ways. And so that does have effects. But the fundamental effect is less on the quantities and more on the prices. And so before I move to that, actually, how much time do I have?
You have 4.5 minutes.
So very briefly, before I move to that, that doesn't mean, I forgot to say this, that doesn't mean that I don't think that the recession is impossible. But what I would look, although I don't disagree that uncertainty is not good, that uncertainty is good, sorry. I don't disagree that uncertainty is a negative. What I would look as an objective sort of thing to, and where I would be afraid of the possibility of a recession, is less, a lot of, the bond market is what's shown here. And you can see that when the bond market, this is the, it's not my favorite, but 10-2 is the difference between the long-term rate and the short-term rate. And whenever it's negative, we have a recession. Negative recession, negative recession, negative recession, negative recession, almost negative, recession. It's been negative and we didn't. And actually the bond market has been slightly panicky. At this point, it's still positive. I don't see the yield curve inverting. A positive yield curve is a good thing in principle. So I'm not too concerned about that, but sure enough, people. But the one I was looking is this. This is private residential fixed investment, and this again, every time it's sort of negative with three exceptions. I actually show them here. You have a recession. Every time it becomes negative, there is sort of a recession. The exceptions are 51, Korean War, 67, Vietnam War, and 2021, 22, the Biden fiscal package. Which, even though Larry Summers says the worst, macroeconomic mistake in the last 40 years, what's probably what saved us from a recession. It is positive. It's sort of the last numbers, again, turning negative. Why am I looking at this? Because, there's a famous paper that says housing is the cycle. So when the housing market turns negative, there is, a significant impact on the ability of people to consume. So our borrowing is very much tied, middle class borrowing, very much tied to the housing and market. And so if this turns, the other thing that it's negative is exactly inflation. So I would look at the Fed. If the Fed decides to hike interest rates and or at least not reduce them when a housing market that it's turning, we may very well have a recession. Again, not based just on the uncertainty, based on looking at the actual data, which I think it's a more reliable way of looking at this. I don't have a lot of time. I have probably less than 2 minutes. So I'm going to say the following thing just on inflation. So if we do get a shock of the size, so, Chris already said the Yale lab says about 2%. If you do back of the envelope calculations, not very different from what Geoff suggested. So if you put, an average tariff, I wouldn't say 10%, an average tariff of say that it goes to 30% on, you do the math of, even if it's higher because there are intermediaries and things that go a little bit back. So let's say it's 30 over 30% of your GDP that you are increasing, you're going to have an increase in prices of 9%. It is inflation, but it's like the, like the pandemic inflation. In what sense? That the period of very high tariffs that Trump loves, the McKinley era, here, which is also a period of oligopolistic power, great corporations, all of that. It's a period of deflation. And the reason for that is that, for the most part, workers didn't have the ability to push back. And at that point, also, I should say, when we did get very high inflation in the 70s, the other thing that was relevant is the 5 founding countries of OPEC were very powerful. And they maintained the price of oil up. And that's not the case. So those countries, Iran, Iraq, Kuwait, not Kuwait, Kuwait is in the Venezuela, Saudi Arabia, I'm missing one there, but they all have very little global power to hike prices. So what I would expect if inflation goes up is that it goes up, but it goes relatively fast down. So I wouldn't expect a lot of that. So the little joke is I don't think we're getting a stagflation. What we're getting is stagflation. So the prices of eggs did go this last month. Report today says they went up by 6% in the last month. They went 60% over the last year. And that's mostly associated with a significant collapse of the production of eggs because we killed a bunch of chicken because of the avian flu. So I don't think that we're in the risk of stagflation. The message is this is not the 70s. tariffs are a terrible idea, as they both told you, but I don't think they will cause the collapse of the macroeconomy. Thank you. So we'll open it up to questions. And I don't know, Chris, look, do you mind changing chairs with Chris so that he can put the chair over here and you can sit here in the front? And we'll take questions. I think there is a question already from somebody online, which I'll read and then we'll open up and people have questions. So the question here is by Cameron Sims. He asks, I think, Chris, this is for you. How much of this market crash is because people are uncertain, panicking, and how much is because things have actually rushed back?
Yeah, I'm not sure. I mean, for me, uncertainty is the real thing that's gonna be driving the economy down if we see it. And I think that, like one of the charts that Matías showed was showing you investment. You know, it was a private residential investment, I think. But if you look at investment flows, they're wildly volatile from year to year because they're all based on expectations of what's going to happen. And if people are feeling confident about the economy and they're confident about what government policy is going to be, they're much more likely to raise their investment. If there's a big uncertainty, then they pull back. There's a famous paper that looked at the start of the Great Depression, and one of the things that happened was the stock market was really volatile in 1929. And then consumers stopped buying durable goods. So they stopped buying refrigerators and cars and things. But they stopped buying things that lasted a long time. Housing is volatile in that way. And so if you get uncertainty, then you have reductions in investment, you have reductions in certain types of consumption on durable goods, and then that can drag you down. Yeah. So that's my kind of reasoning why I think uncertainty is a critical thing.
Yes. Say your name.
I'm Daniel. Do any of you think that this could be found and or tried as market manipulation from the president?
I think the evidence is pretty overwhelming. Yeah, so Geoff said, and I think in good faith, that the objective is supposedly to reindustrialize, but it's a fractious coalition. Many people within the Republican Party do not want necessarily reindustrialize. Musk was very clear that that wasn't his objective. The president himself, he says one day we're going to reindustrialize. The following days it's an instrument of negotiation. So I think that there is and they did that with cryptos too. So what happened? What Daniel is alluding there is that they put this massive thing, markets collapse. He says it's time to buy because it's low, and after before that there were a lot of people already sort of buying. So it's very likely that it's market manipulation. I should say in Argentina, the crypto stuff was also done by Milei. He, our president there, he said, that he thought that this particular crypto was a great investment. Then he vanished for 2 days. Somebody that we don't know, sort of, had a sell-off of this after the price went really up after 2 days. And he's being sued in the Southern District of Manhattan because that's illegal. So I don't think it will happen to Trump, but I think there are indications that, and again, I think the important thing there to think is he's having intervening in the Department of, the Department of Justice is, going against law firms and other groups that tried to suit him in the past. So, and faster than universities, they fell all in line. So I think that I wouldn't expect much to happen in that arena. I don't know what you guys think about this, but I think it's possible. I don't have any evidence that that's true. I don't want to be sued.
Yeah, the Commerce Department said there's nothing there and they're not gonna investigate, so I'm sure we can trust the Justice Department and.
So the legality issue that I raise is, does Trump have the legal power to raise tariffs? Because tariffs are Congress's authority. Congress allows the president to raise tariffs in a time of national emergency. So Trump has to declare that there's a national emergency. And he's claiming that the big trade deficits are a national economic emergency, which gives him the power to do this. I'm sure that he could be challenged in court. I don't think there's really a national emergency when we've got a 4% unemployment rate and the economy is doing pretty well before all of this. So I don't think that he really honestly had the legal authority, but I also don't think the courts will step in and say, president is wrong, that there's a national emergency. So I think they'll allow this to happen, but I think if we were really enforcing the law as it was written by Congress, as they intended the president to use it, you would say the president did not have this.
So I don't know if you can say something about this document by Stephen Miller, the one that talks about the whole argument behind Trump's idea on tariff. Because but I really like reaching out what he says, this is not for getting more revenue, but it's a strategy to use as a political tool for getting some gains. But also it's like a lot of, like arguments about overvaluation of the dollar, and that is the problem that there is a reserve, reserve currency for the world. So I don't know if you have read on those arguments that Steve Miller said, like that's why a lot of people is wrong about tariff, and it's a good strategy to reindustrialize and so if you have something.
So what I would say is, the dollar will go down in value if people want to stop wanting to buy U.S. assets. And I think probably we'll see some of it. That's a legitimate possibility. The tariff, the trade deficit would then probably go down. I don't think that would necessarily be a great thing, for us. But yeah, so I don't know. I don't see I know Trump does want to devalue the dollar and argues that would help our exports and reduce our exports. I don't necessarily think that's a great strategy. I think we benefit from this kind of basically giving us low interest loans by lending money to the U.S. If he was willing to do that, once they stop doing that, we're going to have to. That's my take.
I haven't read the full report. I received it and I was reading through it. So my take is that I'm slightly different than Chris on this. I think that when you look at holdings of the dollar have been more or less stable for the last since the end of Bretton Woods. It's been about 60% of central banks hold dollars. I don't see a significant, possibility that would change very rapidly. Nobody will go all of a sudden to hold yuan. How many of you in terms hold, money in dollars to hold renminbi and see if it's a safe place to hold? And the euro is also not particularly an alternative. So it's not because the U.S. has, it's in the world that we live. It's very unlikely that anything will sort of significant change, I think. And the other thing is a lot of this depends also what the Fed does. And if the Fed keeps interest rates high, that makes it harder for other countries to attract, flow. So I don't think he's going to end up depreciating the dollar. I might be absolutely wrong on this. Again, forecasts are just to prove they are a fool. But I'll say this too: the VIX, so the volatility in the U.S., I think is less relevant in the U.S. I think investment of, gross formation of capital depends on the accelerator. So if the economy continues growing, investment will be fine. However, if you're in Argentina and the VIX goes up, that is an incredible amount of volatility on you. The country risk goes up. The VIX is highly correlated with country risk. And that means for developing countries, there'll be depreciation of the currency. They're going to go into a debt crisis. Possibility of that crisis for developing countries, I think, increases because of these policies, but not necessarily for the U.S. because it's all in dollars. So I'm less concerned about the U.S. Perhaps it reflects where we come from the world, and I'm more concerned about what will happen in the developing world. And I think that's a consequence of this. But again, God knows, Trump will talk all down the dollar. There might be other mechanisms by which the dollar may get depreciated. I would agree with Chris that that's a terrible idea. I don't think it's a good idea to diminish the U.S. trade deficit. There's no particular good reason to do that. So on that we are 100% in agreement.
If I could just reply real quickly, I think that what we saw in the last week was like the dollar going down in value, which was a little surprising. Usually when you put on a tariff, that makes the dollar go up. So something else must have been happening that was pulling the dollar down.
So I think it would be a mistake to attribute any understanding of the actual macroeconomy to Trump. So, I mean, and it's also true, I mean, it's not just Trump. In general, most businessmen understand their industry and very little else. So they're just not good at macroeconomics. They don't study it and they don't understand how it works. So Trump demonstrates a lot of the misunderstandings about macroeconomics that is very typical, actually, of CEOs of something like a real estate company, right? In which the things he cares about, like the inflows of cash, aren't actually the same thing and aren't important in the same way. I mean, if you know anything about money, for example, you know that we print dollars and we can print more of them. So the fact that we're not short of dollars, right? And so this whole idea that we have to care about that and worry about inflows of money it's just wrong macroeconomically for the most part. So I don't know. Is this a political ploy? I don't know. Is Trump an evil genius, right? Did he intend this on, like he's saying now that he intended to use this as a negotiating ploy, but if you read all the behind the scenes stuff, it's not true. Like he was planning on sticking with the tariffs and he was surprised when markets dropped 20%. And so that was what talked him back from the end. So I think it's more somebody who doesn't understand basic economics, who had no good economic advisors. The people in his administration are not good economists. So he picked yes men to staff his administration. So he's getting very little good economic advice. So I think we're just getting bad policy that they then later rationalizes. Oh yeah, I meant to do that, right? So now he's saying, oh, it's just a negotiating ploy. Well, fine, but you know that's not what he said 2 weeks ago, right? So which is it? And this also does feel, I mean, I'm much more pessimistic than Matías in that I think this constant back and forth, like if you're Apple, how do you know that you can make money in your iPhones? You produce most of your stuff in China, but you know, you design them here. You don't know one day to the next, are you gonna have 125% tariff on your China produced stuff? Or is it gonna be 10%? Is it gonna change? Is it just a negotiating ploy that will be different in 3 months? Firms develop these supply chains over decades, right? So the idea that Apple can just adjust on like that to the whim of the week in the Trump administration. So I think already seeing this in cars. The car companies, he's put a tariff on foreign cars, but then he said, oh, maybe not for the ones in NAFTA, and right, like, so American car companies are not expanding right now, right? So like if his policy was to protect and develop the car industry, it's not achieving that. And it's not mostly because of uncertainty, because you just don't know what your costs are going to be, whether or not you can still use your Mexican factories, or you have to rebuild them in the US, or if that'll change next week. So why would you do the $1 billion investment that wouldn't be needed to do? I mean, like, nobody likes to make those kinds of investments in an uncertain environment. So until this is stabilized, and you see this in the field from Wall Street executives, they basically said, begging the Trump administration, just be consistent so we can make some plans. Because planning for investments in, especially in factories, that's a 4-year process, minimum.
I have 2 questions that I'm going to read here. So one is, can tariffs be used as a negotiation tactic? In other words, can tariffs on China force them to engage in fair trade, have the upper hand? And the other one is, we had the largest, fastest growing GDP in the world since COVID. Well, I'm not sure it's in the world, but it was a fast recovery, given that. Isn't GDP a better indicator of economic health than the trade deficit?
So my quick thoughts on those 2 things. I think if you're going to use tariffs as a negotiating tactic, announce that you're going to put tariffs on in 6 months, and then have 6 months of negotiations, and then you either put the tariffs on at the end or not. Don't surprise everyone with them, and then cause the harm, and then afterwards say maybe we'll negotiate it. The U.S. has done fantastic as an economy compared to the rest of the world. So Japan was like 50% richer than the US in 1995. And today we're 50% richer than they are. We're like a lot richer than they are. You know, so compared to other developed countries, the US has done fantastic over the past 3 or 4 decades. And we've done that while we've had this big trade deficit. So there's not a national economic emergency that the trade deficit is causing. So I was thinking of this analogy that if you think of the trade deficit as maybe something that's a little bit negative, right? The Trump administration says you got to take your tariffs as a medicine, right? We've got a sick economy. So what I would phrase that is tariffs are like a splinter that you've got, right? And then the Trump administration comes in and amputates the arm. And that, that solves the splinter problem. You may not have that trade deficit anymore, but the negative consequences are much worse than the splinter would ever. That's my kind of take.
Well, what I would say is, I think one of the reasons Trump was elected is because of the hollowing out of the manufacturing sector in the US and the decline in the fortunes of the blue collar working class in the United States. And that's also happening in other developed countries. So there's a lot of animosity towards China and towards global economies in general, and some of it is warranted. I mean, there's pretty clear evidence that trade agreements have caused a shift in the jobs in the United States away from manufacturing that were higher paid to service sector jobs.
5 million jobs lost since China entered the WTO.
Exactly. So it's a large number. So that's the problem. So even though the macroeconomy is doing well, not everybody in the macroeconomy.
5 million manufacturing jobs, I should say.
Yeah, right. So I mean, this is why it's legit to be worried about it's not that necessarily the trade deficit that's the issue, though. The issue is quality jobs and how you create those. You could make service sector jobs quality jobs if there were decent minimum wage and labor unions that got people paid well, right? So it's a lot. There's a lot of complexity to the issue, and solving the trade deficit. You can have absolutely shitty manufacturing jobs. I mean, nobody wants to do most manufacturing jobs where you do one thing all day long, right? It's not a great job. What you want is stability, right? And decent working conditions. That can happen in lots of different ways. That's almost a different issue in some ways. Although I'm not opposed to reindustrializing, right? The question is, what do you want to reindustrialize? And also, what policy would do that? And none of this is going to do that.
Yes, just a quick point on what Geoff just said. Tariffs can work in a protectionist way to build up your industrial base, right? And that was foundational to the industrialization of most developed nations today. However, the loss of jobs that we've had in manufacturing, I think people means that the industrial base of the US has been hollowed out. And that's not true. The value of manufactured goods is more today in real terms than it was when we had all the jobs in manufacturing. So I just want to make it clear, it's not that we don't have a strong industrial base in this country. We have a strong industrial base, except it's built by machines for the most part. And so when we talk about reindustrialization and bringing jobs back into this economy, you got to think, why are the jobs abroad in the first place? Do you want to take a job in manufacturing at $3 an hour or $2 an hour and try to get by?
That should be complemented with another thing. So it's true that, if you go to my blog, several posts on that. So it is true that, so for example, NAFTA didn't do much. We lost 500,000 manufacturing jobs because of NAFTA. So now Mexico didn't do much. China did. However, importantly, in 2008-9, real value of manufacturing production in the US went up. Since then, it has stagnated. So it's not true that so we don't know exactly what, but from the last, 10, 15, almost 15 years now, manufacturing production in the US has stalled. And that's is an issue. So, we to remain a developed country, does it require to have a strong manufacturing base? And the United States has stalled. And I think that the other thing here that it's the underlying sort of issue, which I think it's, in accordance to what they were saying. So there is a trade dispute with China. I think that a lot of this sort of thing is the anxiety that Geoff was saying with respect to China. But, that dispute now in serious sort of strategic places, there seems to be a possibility that China will have the cutting edge technology. And the sort of concerns of that, I think, are geopolitical, and is what's underlying a lot of this. Having said that, I think that we all agree that the best way of managing this geopolitical conflict is not by, changing announcements and at every 5 seconds. So I think that there's no industrial policy behind this. Actually, in terms of industrial policy, the Biden sort of CHIPS program, Geoff was showing South Korea, the CHIPS program of, Biden was sort of a regional way of doing industrial policy concerned with the, disputes with China and so on and so forth. Very briefly, the response there, GDP is not a very good measure of health of the economy. GDP per capita, perhaps it is, and I think that's what Chris was alluding, that the US GDP per capita. I would say another one would be, in my book, inequality, and the United States doesn't do very well on that, and I think that that's also something to take into consideration, but that's another sort of discussion. I think we have one more question, and we have perhaps closing arguments if you have or something like that. Anybody else? Yes. Nate.
So it's Trump's economic policy, like in the election, he was very firm. It was like, oh, I'm gonna bring jobs, more money, for the price of eggs, blah, blah, blah. I mean, he's going through this tariff policy as an act of like protectionism. So like hypothetically, if we're in a world where these tariffs are like actually successful, is it like a nationalist propaganda, or is it like is it gonna bring jobs to the US, or is it just gonna make the US more profit and not give us more jobs?
So I don't think trade policy affects the total number of jobs. I think it affects the types of jobs you have. So as a result of the tariffs, we'll have more jobs in industries that we normally import goods, things like clothing and apparel. We'll have fewer jobs in industries that we would export to other countries. But the exporting jobs are higher paying than the import jobs are. So I think when we block off trade, largely what we do is we shift jobs away from sectors that we get high wages in and shift those toward jobs in sectors that we get low wages. But I think the overall number of jobs is based on overall macroeconomy, monetary policy, things that are largely unrelated to it.
I agree. I don't have much to add to what he said. I think that a big chunk of the, so there was a discussion last semester of whether the American economy is under secular stagnation or not. There is a reasonable sort of, view that was here defended by one of our professors, Aslam. She suggested that it is secular stagnation. I tend to think in the structuralist that it's not that surprising. The opposite. I think that part of the story is that the US government has sort of decided to spend on certain things that have not promoted growth, but so I think that the Obama recovery was very poor, and I think that caused a lost, it was a lost opportunity. I fear that that's what we're getting into. It will look like the first Trump presidency. So even if it's not a collapse, I'm more than I don't see it yet. I'm not saying it's not going to happen, but I see it as slowing down, and we're going to have a very, poor sort of performance in the next 4 years, irrespective of trade. Trade can only make it worse. That would be my last comment. Geoff, if you want to.
Yeah, I mean, I see no chance of this working as they're currently structured. If they're used as a negotiating ploy, even if it reduces some of the trade barriers with China, that doesn't solve the underlying issues. So I think it's very unlikely that it will work in the ways that Trump has discussed. So I don't think they're going to create a lot of jobs. In fact, just the opposite. I think right now we're seeing that it's going to hurt jobs. So I see no chance of it working as currently structured.
I largely agree with that. I mean, I think that especially if it's just a negotiating ploy, then that creates more uncertainty. We don't know what the outcome of the negotiations are going to be. Uncertainty.
You guys want to stay, so though I know that several of you have to leave, but there are more questions. I'm happy to entertain a little bit more questions. Yeah.
My name is Lily, and I was wondering, like, with the value of money, do you think that this is kind of like the monetary necessary, but if our government print more of the money, if we change cash, like our natural resources for export and exports, do you think that would make our deficit be better in the US?
Trade deficit or fiscal deficit?
Either. Maybe trade.
Again, I'm somewhat unconcerned with the trade deficit as Chris, and also I'm not sure about them. Somewhat unconcerned about the fiscal deficit. I don't think that there is particular reasons to be concerned with the size of the fiscal deficit. we'll see what happens with the dollar. It's true what Chris said. It did weaken, last week, and in part also you saw that on the bonds, but that doesn't necessarily signal, I mean, everybody thought that the bond market was stopping this. I think the stock exchange might have had a role. I don't think the bond market signaled a upward sloping yield curve is actually a boom, not a recession. So I don't see necessarily that as an indicator that we're in trouble. So I don't think that, again, I don't think that, exchanging, using dollar, I mean, in all fairness, is what Chris said, we're having here an incredible, that's what Warren Hosler and MMT people tend to think. They don't care at all. I'm appointed to Ivan because he's MMT connected, so, but he's trying to. But the point is, I don't think that, they are certainly MMT people don't think, even more strongly than I do that, the trade deficit and the fiscal deficit are an issue. And Warren has recently spoken against this tariffs as far as I saw something, from him. So I don't think that MMT would justify this kind of, policies.
And I'll just add that I think we do benefit as a country hugely from having dollars being held all around the world. And, like every time the US prints more dollars, right, the value of those dollars goes down a little bit so everyone who's holding dollars gets taxed a little bit when we print more, right? That means we can effectively tax all the foreigners that hold dollars just by printing a little bit of extra. So I think that just having the dollar as a reserve currency has been a huge value to the United States. I agree with Matías. I think it's very unlikely that the dollar will stop being the reserve currency anytime soon, because there are everyone uses dollars because everyone else uses dollars, and it's hard to get out of that equilibrium. But the other possibility, though, is that if you shifted to a new equilibrium where the euro was the reserve currency or something else, then that could happen very quickly. So I think that's a very low probability of happening, but it's one of those things where we would lose out.
I think if there's enough volatility, investors will look for something safe. So I think Trump, if he keeps being as erratic, it could happen. I also think it's important to differentiate. Devaluing the dollar affects different industries differently. So if you're a goods exporter, devaluing the dollar helps you. So General Motors exporting cars, devaluing the dollar makes their cars cheaper, or foreigners, they'll sell more. So devaluing the dollar helps General Motors. Wall Street's money is worth less, though. Wall Street has a huge amount of investments overseas. In fact, many years, most of their profits come from overseas investments. When the dollar devalues, it reduces the return on investments in other currencies because your dollar buys less. And when it comes back in smaller amounts. So financial markets absolutely hate the falling dollar. In fact, if you look at a lot of the commentary from hedge funds and things like that, they can't stand the fact that the dollar dropped because they basically lost a lot of money. Right, so financial markets absolutely hate that idea, but at the end of the day, it would help General Motors.
Thank you so much for coming.